What's good, YouTube? Here we are back again today with another video, and in today's video we are going to cover 3 different entry types for us to enter our trades. Now, based on the Trade Zone Wisely approach, we basically find out our buys from the higher time frame, and then we drop down to our trading time frame and we plot our zones, and we wait for price to return to these zones. On the first return to the zone, we look for our entry. Now we have 3 different entry mechanisms, and I will go over them today so that you will have at least tools to help you in your analysis, and then also will help you understand why it is I entered a trade, should you, for instance, in the future videos see me enter in a trade. So for our entries, basically we can have more than 3, but for simplicity's sake I will just cover 3 entry types. Now the first entry is very simple. If you have your zone already drawn out and price has left the zone and you're anticipating the price to return to the zone for the first time, one thing you can do is you could just place an entry right at the top of the zone if it's a bullish zone, and if it's a bearish zone and you're expecting price to return to it from beneath, then you can place an entry right at the bottom. So basically right at the edge of the zone you can place your entry there, and then your stop would be on at the other side of the zone. Make sure to leave at least a few pips to cover for spread. You can put 2, 3, maybe even 5, whatever you feel comfortable. And also the entry, you might not want to put your entry right at the zone itself. You might want to put your entry maybe a few pips just before the zone so that it would account for spread. Or if you have a very tight spread, your broker is like less than a pip spread, you can put it right at the zone. You know your broker better than I do, so you just make sure you account for spread, because sometimes if you do not account for spread, the trade can come actually tap the level and leave without tagging you in, because it needs to account for spread. So always make sure you account for spread. And it's also healthy to give it a few pips buffer so that you make sure you enter the trade. There's nothing more annoying than planning out your trade, waiting for the trade comes, taps the zone or barely taps it and leaves without you. It's so painful. So in order to prevent that from happening, and if you've been trading for a while, this has definitely happened to you more than once, you know that feeling. So make sure you account for spreads. I know we want to keep our stop losses tight, we want to keep our RR very high, but it's better to be in a trade than to be in no trade whatsoever, especially if you've been planning on waiting on this trade. So I would recommend, depending on the size of the zone. Some zones can be big, like for instance here you can see this zone is quite big. Let's measure the size. This zone is 59 pip, 60 pip zone, while this zone here is a 35, 36 pip zone. So depending on the size of the zone, if the zone isn't too big, account for that spread. Place the order right there at the beginning of the zone, and then place your stop loss on the other side of the zone and account for spread as well. So account for spread on both the entry and the exit, because some people only account for it on one side. You have to account for it on both, because accounting for it only on one side and not the other side, if the trade does maybe go in drawdown for a bit and it comes to the other side, it could tap the lower part of the zone, and if you didn't account for spread, it would take you out prematurely. But if you have accounted for Z, so you're letting the trade anywhere within the zone, price has a right. That's why we drew the zone. The zone has specific boundaries, and what we are saying by drawing this zone is the price has the ability to go anywhere within this zone. But if it goes beyond the zone, that's where the invalidation of our trade idea starts to prop up. Now, does that mean it will never exceed the zone? Sometimes it will. You can't really control price. Price is really controlled by supply and demand of orders. When there's a lot of orders in the market, a lot of liquidity injected into the market might get a bit excited, and then sometimes it might exceed. And this is just a reflection of the price, the amount of orders in the that specific currency pair or asset you're trading. It's not an exact science to the pip, but with technical analysis and some risk management and trade management, you can get really, really close. So you always have to account for potential slippage in terms of orders just being injected into the market, or maybe a fundamental news announcement, or whatever the case may be. So always account for spread. Don't be stingy. It's better to be in a trade than not in one, just because you're too stingy with the stop loss. So that's the first entry. Now for the second entry, what you can do is you can split the size of the zone into two, and then place your entry right at the 50%. Now I really like this entry because it automatically reduces your stop loss size, so you get a bigger RR and you get a better entry, which means less drawdown, potentially less drawdown. But it does come with one drawback, which is sometimes price doesn't really reach the 50%. It just taps the top of the zone, or it stays within the first half of the zone, doesn't really reach the 50%, and then it takes off. So there is that risk. So if you're going to set an order and you're going to leave, maybe you won't be at the charts, you won't be there to actually monitor it and see what it is, and you have you really want to be in the trade, but you don't want to be there to actually manage it. So that could be another opportunity for you, especially if the zone is big. If the zone is really big, dividing it into two and entering at the 50% is a good strategy, and I personally like that. As you can see, this trade right here was actually entered based on the 50%. So I basically, what you would do if you don't know how to calculate this, you can just use your fib tool. You can use your fib tool and then just select the top to the bottom of the zone, and then you can see this line that I have here. It basically highlights for me the 50% of the zone. It even gives me the number here. So all you have to do is just go to the fib settings and select only the 0.5, and then you can hide all the other levels. Or you can just use your normal fib, and your normal fib should have the 50% marked up. So let's see, let me use my normal fib. Let's see here and change it to fib, and as you can see, this is my normal fib. It has all the levels, but the 0.5% is there too. So make sure you just identify that level and then place your order right there. That's another thing. And then the stop loss is the same. It's still going to be just beyond the zone. Account for spread, 2 pips, 5 pips, whatever the case may be. That's the second entry. Now for the third entry, this one is also a really good entry mechanism. What you do is you wait for price to return to the zone, and once price is in the zone, you drop down to a lower time frame. So if this is a 4-hour zone, you can drop down to an hourly time frame or a 15-minute time frame. For me personally, I like to go to the 15-minute time frame. So for instance, in this case, on this first return, what I would do is once price is reaching or has reached the zone, I'll drop down to my 15-minute time frame. And what do I look for? I look for any reversal pattern. It could be a bullish engulfing, it could be a pin bar rejection, it could be a morning star, it could be tweezer tops, it could be a doji candle, whatever kind of reversal pattern that you like, that you've seen and you have faith in. Because the thing is, we already have a bias, right? We are expecting bullish momentum. We already have our zone. We're expecting a price to bounce from the zone because the zone has been validated, because initially there was a large influx of buy orders from that zone, and it also broke a swing high, all which are elements to our trade plan here at Trade On Wisely. So we have all these things working for us. So right now, once price comes into the zone, what we are expecting, what we are anticipating is bullish momentum. So once you see your bullish signal, you can use that as your entry. So if for instance you're using a bullish engulfing, now this bullish candle did engulf this bearish candle by just a little bit, not that much, but it did engulf it. So you could, right after seeing this candle form, you could enter right at the next candle. You could enter your trade there, and you could put your there's 2 stop losses for this trade pattern. You can either put your stop loss beyond the low of the candle or the candle formation that you used to enter. So if you were using the bullish engulfing, you would enter here, and then your stop loss would be below here, so you account for spread 2 or 3 pips. That would be the aggressive type. So this will give you a really tight stop loss, a really good RR overall on your overall trade, but it also has the risk of price could come back and then take you out. So the other stop loss placement mechanism you could use is the same as our original, just beyond the zone, just to stay clear. Now this is on a trade by trade basis. Not all trades are created equal, not all zones are created equal, not all signals you will get are created equal. In some cases you might get a bullish engulfing that the engulfing comes all the way out. So if you enter over there and then you put your stop loss over here, you might have a bigger stop loss. So you have to be aware of which entry mechanism you want to use for which trade. You don't have to use a specific mechanism every single time. You can read the market and see what the market is providing to you and then adjust accordingly. But these are three very simple entry methods that you can use. The first two, you don't actually have to drop to the lower time frame, so you can trade straight from the 4-hour time frame. And one would think that trading from a 4-hour time frame means having a huge stop loss, but as you can see, this zone was 30 pips. So my stop loss over here, as you can see, is only 21 pips, and that's trading directly from the 4-hour time frame. And as you can see, this trade has been just moving and it's still in profit. It has not come back, it has not taken me out. You would have moved your stop losses to break even way a lot sooner than this, so you're basically risk free. And now the trade is running at 130 pips in profit, and that's what, with a 20 pip stop loss, that's 1 to 6 hour trading from a 4-hour time frame. So don't believe it when people say no, you have to go to a lower time frame in order to get those tight RRs. It's really about your strategy and understanding your strategy, and also being consistent with your strategy. So I hope you liked this video. Stay tuned for more, and I will keep dropping gems like this as we go ahead in this trading analysis Trading Wisely YouTube channel. Peace out.